gentlemen, I was wrong, man. We're slowly tippling our toes into that Google stock only to see Snapchat finally post earnings, devastating the likes of Meta, even the likes of Amazon, and of course Google. So we're going to talk about my plan and how I want to buy Google stock as we kind of head into this temporary, growth freezing phase as everyone's freaking out, opening up a window of opportunity for those looking for long-term potential growth. We're going to be breaking down, obviously, my perspective on this market. Many of you know I don't care about value investing. I don't care about penny stocks, day trading, any of that crap. I just play the field and figure out what works in the current environment for me. Might not work for you, but to kind of framework this before we talk about some of the stuff going on with Snapchat, guys, I want to just give you a quick insight into Everything Money's recent video and talk about how this kind of relates to different stocks and why I don't think value investing is typically the best strategy to follow, tried and true. I mean, we're not all going to be Warren Buffett. We're not going to be the 2% that over a 30-year period or the 1% that actually outperform the S&P 500, but take a listen because it has a lot to do with the ARK Innovation ETF.
ARK Investment ETF hit a high of 160 last year. It has done nothing but plummet since. It's currently sitting at $45 per share. She still sees inflows. This is part of the reason why I don't believe we're at a market bottom yet.
So he thinks we're not nearing a bottom yet because too many hype investors are chasing after the ARK Innovation ETF, things like Tesla. And I want to talk about this a little bit in the Western world because there is somewhat of a branding value dilemma when it comes to valuing stocks. I mean, we saw Tesla recently run up pretty dramatically on its earnings, crazy overvalued, very hard to project out into the future what the revenues and earnings are going to look like. But what we do know for certain when it comes to Tesla is that for the foreseeable future, the growth is going to be absolutely absurd, and Tesla has baked in this valued brand that leads all of these hype, all of these Tesla fanboys to be holding die-hard Tesla stock literally into their grave, and it's hard to bake in what that bottom line is for a bottom in Tesla stock. But we can see the same thing with other branding companies like Apple. Apple has always been truly valued at its premium. I mean, Apple hasn't traded at a discount in forever. A lot of people say, well, the growth is there, this, that, we could justify a 25 PE. I mean, we even saw Warren Buffett buying it, I think somewhere back here on the dips, and then it continued to dip. Whether he's buying more, questionable. I mean, look at things like Nike, right? Like, these brands have so much power that it's very hard to justify the future cash flow that something like a Nike is going to generate just off that name brand alone, right? So these things trade at very high multiples, 29 PE, much higher than the current market multiple. I think the S&P trades around 19 right now. But let's talk about value stocks. And the problem that value stocks tend to have is branding problems, right? Look at Alibaba. Foreign geopolitical branding problems. This thing is trading at a very good discounted territory, in my humble opinion. The likes of Charlie Munger have been buying it, but the thing you're going to have to get over, no matter how good BABA's earnings are, if you can't get over that hurdle, that stigma over China, this thing will always trade at a discount for the foreseeable future. It's the same problem that I had when I was trading Geo Group, right? This is the likes of Michael Burry have been buying these prison stocks because they trade at such ridiculously cheap multiples, and prisons aren't going anywhere, but that doesn't matter. The problem is that there's no one willing to buy the stock. If you can't get hedge funds, pension funds to open up that gateway of hundreds of billions of dollars to put it in that fund, these things will never see any kind of really ridiculous growth. Same thing with things like Altria Group, right? Altria Group, a lot of people have been screaming is a great company, yet I sit here and I listen to these, the CEOs of this company spend money, pay out huge dividends, have absolutely no growth. Everything they've touched for the last 5 years has gone to pretty much zero when we're talking about the advancements with Joule, IQOS, getting involved with Philip Morris. Their branding power has just become crap, in my humble opinion, and people chase yields on this thinking it's like a value play, but there's no future hope in this when there's a compounded rate of growth, of literal growth, declining growth of people smoking, right? So it's just these brands are losing that power over the general people that exist, right? I mean, it's all a voting machine. That's what the stock market is. So the voting machine has said, forget these stocks, so they're discounted, and you're taking your own speculative bet on the branding power in the future, right? Even though they're cheap. So where we can kind of look moving forward here, I mean, Meta, Facebook, incredible company, insanely cheap. I would argue that this one being in the Western world, the stigma is still there. A lot of people don't like Mark Zuckerberg, but this one, I think if you're going to pick any of these stocks at a value play, at least it's not dealing with the geopolitical events, that there is good potential here. But let's talk about when it comes to value investing with things like Amazon and how this relates to Cathie Wood's ARK Innovation ETF, because Amazon is a stock that Everything Money would never buy. I noticed that they said, oh, maybe in the future I'd buy Tesla if the value started making sense. They'll never buy Tesla because it's a growth beast. The same reason that Amazon has been a growth beast. I mean, take a look at, first and foremost, the PE ratio. The historical PE ratio has always been insane. There has been no real way to truly value Amazon because it's only had absurd revenue growth. So when we take a look at it, all the way up to 2018, it was trading at a PE of 182. But if we don't take a look at the bottom line EPS, because the EPS wasn't really rolling in as quickly until, in the latter half of the last 5 years, I mean, take a look at the revenue growth here, guys. The quarterly revenue growth has been absolutely absurd. And now that the value is starting to come into play as the EPS, that bottom line cash flow that value investors pay most attention to, as they start adding that cash flow into the future to the bottom line, we can see that that's during a period when their growth has really fallen off a historical cliff. So you would have missed out on all of this insane quarterly revenue growth because you couldn't value what it would be worth in the bottom line. This is the problem with growth investing versus obviously value investing. It is very hard to put a true value on the future potential of revenue, right? So let's talk about some of the ARK Innovation holdings. I mean, Tesla, Zoom, Roku, CRISPR, and just take a look at some of these, because when you're talking about things like Zoom here that has fallen off an utter cliff, the PE ratio is still a little bit high, but this thing was a true growth beast, right? I mean, take a look at this from 2020, even 2019, doing $330 million to $4 billion just a mere 3 years later is pretty insane, right? Now, obviously, as we go into this kind of recessionary period, this is where we're going to start seeing the growth investors die off, because you're really going to have to do some due diligence to see what companies are going to come back after this temporary freeze, because it's a self-fulfilled prophecy, man. I don't think the economy is as bad as the media might make it out to be, because as people freak out, my family, my friends, I know people canceling their Teslas because they're very skittish. A lot of people are spending a lot less money just because the future seems relatively uncertain, and all of that compounds above the actual underlying problems within the economy and the inflationary pressures, right? Let's take a look at something like Roku here, another stock that's fallen dramatically off of its highs. This company in 2018 did $742 million in revenue, in 2021 $2.7 billion. But again, you're not going to see much of that hit the bottom line EPS, and it's really hard to value that into the future. When there is no way to value the future bottom line cash flow, you're purely speculating, but you're always going to be speculating with any company, because you're not just going to be buying, let's say Google, for example, and we're going to get into this in a second, but you're not just going to be buying Google for the advertising play. I mean, we're talking about AI, we're talking about self-driving, we're talking about genomics. Google is an expansive ETF in and of itself into a multitude of sectors, and you're kind of speculating to kind of get some growth out of that at some point in the future, while you also have this underlying business that is very cash positive, right? So everything else is the cherry on top of the cake, is what I like to say as it. But obviously, when you're talking about even like the biopharma sector, things like CRISPR, this is a company that has absolutely zero real revenue cash flow. It's purely projected off basically the fundamentals of its patents, of its core technologies, and what the value that's going to bring to society in the future. That's kind of how the ARK Innovation, Cathie Wood, thinks, and it is by no means ever going to be appreciated by the likes of value investors, right? And again, it does have a higher rate of risk, but then again, equals a higher rate of return. That's why people are still willing to buy the ARK Innovation ETF. So let's talk about Snap. Let's talk about these kind of earnings that just came out here and my current plans and kind of how I play the ball field right now, because with my family, we have been dipping our toes into Google. I think Google's a good buy price around here. It's on the upper end of the value for it. If it comes any lower, anything from where it sits today down is going to be a good buying opportunity. So what happened with Snap? Well, first of all, who the hell uses Snap? It's a $16 billion company. It's literally, it's not even a drop in the pond compared to the mega caps now that it's pulling down. But the fact of the matter is here, Snap guys, they posted reasonably good numbers, but the thing that really pissed off the entire investing community was the zero growth. They were projected, I think, to do 18% growth, and they didn't see any growth over last year, and that's what's freaking everyone out, and that's what I'm going to be expecting for most earnings. But again, over last year, that insane hype up, even if for this temporary period of everyone freezing up on their capital, even if we see a baseline where it just flatlines to where it was last year and we're not seeing real negativity to the downside, I would still post that as relatively good earnings, right? But again, Snap's a small company. It needs to grow. It doesn't have the same kind of pricing power and gluttonous that something like a Google per se has. Now, Google's going to be posting its earnings on July 6th, and this is something I'm going to be very, very fixated on, because right now I've only dipped my toes into the stock again with family, friends, girlfriend, things like that, but I am looking to be buying a lot more of Google. I want more growth prospects in my portfolio, but many of you know in my general portfolio, I do not have a lot of tech exposure as of this moment. I mean, most of it is through the S&P 500 ETF, which I continue to cost average into. But what I'm looking for right now is to let some of this fear bake into this. If this thing continues to drop, the happier I'm going to be, because inevitably after these earnings, I really feel like if that's that could be the potential this quarter to next quarter. That's going to be the potential of basically just the compression of, the lack of spending. But that spending, I highly believe, is going to come back inevitably. YouTube is better than Netflix, damn it. People make content for YouTube. YouTube does not have to make its own content. And it's got way more moating to it than I'm going to say something like a TikTok does, because no one goes to TikTok to search something up. If you need to learn something about your car, learn something about Tesla, learn something about anything, you go to YouTube, you go to Google. That moat is the Timbuktu of the 21st century, damn it. Let alone, again, the massive expansive growth this company has in self-driving and everything else. So what I'm doing right now is I'm waiting. I'm just going to be patient. I'm going to let earnings kind of bake in, see how this all pans out. And what I'm going to look to do is finally start kind of divvying up my VYM. I dumped a lot of money into security and safety. As many of you know, coming into the beginning of this year, this has saved me tens of thousands of dollars to the downside because I offloaded Tesla, I offloaded Facebook and Google way higher than where these things currently sit today. Even though I took some losses to some varying degrees, got a lot of criticism from some of you guys, but again, I can only play the field that I understand and what feels right for my risk tolerance. And in a market like this, I adjusted. I think I could have done it earlier, but it did work out because I was selling Apple, a lot of those companies at the beginning of the year. Even though Apple's coming back right now, I still get a lot of that exposure through the ETFs with less volatility to the downside. But VYM, I parked this in my corporate account. I don't like holding these kind of dividend stocks in my corporate account because they're so tax inefficient, and I kind of expected that. But the thing is I figured I don't want to be out of the market because I don't know what's going to happen. No one knows what's going to happen, so I don't want to give up any potential upside if something unforeseen happens. But when it comes to the VYM, guys, this thing is only down 8% year to date. It has been a very safe haven for me, seeing extended downside risk. But obviously, as the markets start to capitulate, they start to find this new bottom, this earnings freeze up period kind of starts to hit the worst of the worst, in my opinion, which will be this quarter to next quarter. It's a good time to really start loading up on these fundamental tech stocks that I can hold for the next 10 or 20 years and see probably a much higher rate of return because of the levels that I'm currently buying them at. So I'm going to be flipping out of my VYM, not a whole lot of it, maybe $10,000, $20,000 worth of it sitting in my corporation. I'm going to reallocate some of that, probably the S&P 500 index, and then again start buying and loading up on Google, depending, again, just watching the price action come out of the next earnings period. And I could say the same thing with Facebook. I like Google a little more than I like Facebook, but when we're talking about value plays, if I had to throw a dart at one company right now, you're just going to have to ride through the wave and just see what the earnings bring in. But Facebook at these levels is just ridiculous to me, and probably will continue to be ridiculous because, again, branding, Facebook does not have the same kind of branding power, but I still use the Oculus. My Oculus is sitting right here. I still think there's huge potential for a company like this. However, guys, you kind of got to take everything with a grain of salt here. Obviously, this is not financial or investment advice. I can really only show you what I've done, what I'm doing moving forward, and I want to pass the question off to you. I'd love to know what you guys think about all of this in that comment section below, but stay cool, stay awesome, and as always, I look forward to catching you in the next one.